Let's ride.
We start with the troubled global banking sector. European markets have closed down more than 3%, spooked by a major sell-off of shares in the Swiss banking giant Credit Suisse. Coming days after the collapse of the US-based Silicon Valley Bank, it's prompted fears of a full-blown crisis in the sector. So let's look at the damage at the close of the European markets today. Well, shares in Credit Suisse plunged to a record low, falling 24%. Now that came after its biggest investor said it could not give the bank any more financial help. Meanwhile, here in the UK, the insurer Prudential tumbled 10% and the high street bank Barclays fell 8%. The plunge by banking stocks left London's FTSE 100 index down almost 4%, its lowest level this year. Today was the worst performance for the index, which lists the 100 largest companies on the London Stock Exchange since the start of the COVID-19 pandemic. So let's take a closer look at Credit Suisse. Well, today saw the second day of sharp falls for its shares after the Swiss bank yesterday disclosed that its auditor had identified material weaknesses in its financial reporting controls. Its biggest...
Let's bring in the former central banker for India, now the Booth School professor, Raghuram Rajan, joining us right now. I want to start here with the idea of sort of whether what we've seen transpire from Silvergate, from SBNY, from SVB, and now with whatever is happening with Credit Suisse right now, whether that's enough, Professor, to actually knock these central banks off of their primary goal, which was to bring inflation back down somewhere towards their target rates.
Not yet. I think they're going to wait a little more and watch. I mean, the reality is we have two different problems. One with Credit Suisse, which is a bank looking for a business, which has been performing poorly for a long time. This is not the same problem that other banks in Europe have, not even the same problem that the other big Swiss bank, UBS, has. So it's idiosyncratic. It's specific to Credit Suisse. The problem, of course, is it's a big bank, 600 billion approximately in assets. So many banks have exposure to it, and that's why markets are concerned. That's also why the Swiss National Bank is probably going to step in.
10 seconds later.
Latest from Wall Street on these developments. Teddy Ostrow joins me from New York. Teddy, have there been repercussions from the banking sell-off in Europe in the US?
Well, Credit Suisse is a global financial institution, so it's of greater consequence, right, than Silicon Valley Bank, than Signature Bank, which we did see fail this week and cause broader turmoil in the markets here in the United States. Now, the pronouncement by the Swiss National Bank to support Credit Suisse is going to pare some losses. However, we have seen some damage here in the United States. The S&P has dropped 0.7%. Now, really, the banks are the ones that have got hit the hardest. Goldman, Citigroup sliding, regional banks certainly sliding. But what we're looking at is investors panicking, looking around at the financial sector, at SVB, at Signature Bank, at Credit Suisse, and saying this is incredibly unstable. We're pulling out their money and trying to find investments that will pare their losses.
Now, we were just speaking about the difficult situation that central banks find themselves in right now, the ECB especially, because of the interest rate hike tomorrow. How might the Fed react to this volatile economy?
Well, the Fed has two objectives, right? It's to ensure financial stability in the economy and to tame inflation. Now, the latter of which it has been doing from unprecedented rate hikes here in the United States, and it does appear to be bringing down inflation. However, it is causing some financial instability. We can certainly say it contributed to the failure of Silicon Valley Bank and subsequently Signature Bank. There are also some issues there about the Fed supervisory issues. But with inflation, right, we have seen inflation cooling here in the United States. The Fed isn't fully happy with the pace, which is why there were expectations that they would continue to hike rates. However, now with the financial instability we're seeing, there are bets that the Fed is going to do a low hike or a no hike after their meeting next week.
So all eyes on central banks. Thank you very much, Teddy Ostrow.
This is how legends are born.